Welcome to Private Banking Strategies Podcast with Vance Lowe and Seth Hicks, your secret weapon to protect your assets and never have to start over financially again. Vance and Seth help high net worth individuals, families, business owners, and investors structure an asset-protected, tax-free fortress for their families. Learn how to keep what you earn and use the velocity of money to create your own private banking system. Join us on this journey as we explore the secret strategies of the rich and political elite and help you take total control of your financial security. Now, on to the show.
Welcome to Private Banking Strategies Podcast with Vance Lowe and Seth Hicks. Vance, how are you?
Hey, I'm doing wonderful today. I'm anxious to talk about a new topic here that goes throughout things I've done in the past.
It's not a new topic for you. It's something that you're uniquely familiar with. You're an expert at structuring, and that's retirement income strategies. You being a certified financial planner and a wealth manager and earlier in your career before becoming a private banking and strategies expert, you were helping people plan for retirement solely and completely. You know, I've heard it said that retirement planning is broken in America. Would you agree with that?
It definitely is, because the whole premise is founded on a false foundation.
What is the false premise?
Entitlement, retiring in general. The word retirement means to be put out of production. When we talk about retirement, it's the flow of money. See, people will do stuff with money that they would never do with what money buys. No one would go buy a loaf of bread and put it in the freezer for 5 years. They wouldn't buy a car and park it on the curb and not drive it for 10 years. But yet they'll stick money in what's called retirement accounts and just leave it there forever and ever, hoping it'll be enough to provide income. The reason I think you're coming up with that quote is in the past, when I was young, there were things called pensions. The employers would literally take care of their employees. They would take them to a point, and then they would put them into a lifetime income and let them retire from that business. The word retirement was originated in Germany, and it was to try to get the journeyman, the people who had the craftsmen who had the jobs and were the journeymans, to retire so that their people underneath them could take over and get into that position and make more money. So people kept living longer, and so they came up with a retirement. And I think back in the day when it first started, it was at age 60 in Germany, and America adopted that. We adopted that because of, I think, a corrupt idea. Put the person out of production. If we don't have his money yet or her money yet, then they will consume that money and we'll take control of it. The problem is the banking system wants to generate and have control of everything. The way it's working today, and we don't even understand this, the average American doesn't understand that. They go out in the fields and pastures, just like cattle and sheep, and work and produce as high as 25 to 1. They're producing $25 for every $1 they get to bring home, anywhere from 5 to 25 in that scenario. They bring those dollars home after taxes, everything else. What do they do with it? They spend it. It's important that we understand that, because it's mind-blowing to be able to continue that cycle. Bring what we have home and consume it. Our whole life is, if you'll buy this, you'll save. If you spend for this, you'll save. Here's your savings. But nobody saves. Nobody actually takes the savings. The CPA says, if you'll use my services, I'll save you $5,000 in taxes. Do you know that never really happens, Seth? Right. I've never seen someone write themselves out a check for the $5,000 of savings. It's just gone. You go and get 60% off something. You didn't save that money unless you write yourself out a check for that. So people, do yourselves a favor. You could amass a tremendous amount of money in today's society if you'll claim the savings. Here's the truth about retirement. If we look out there across the United States, we've been probably through travel and everything through a lot of different towns. But I have never found a town that has ever hosted or executed a retirement. Economies don't retire. Money has to flow. So there's no such thing as retirement. it would be a lifestyle change. So everything we talk about, I want everybody to understand when we talk about retirement income, this is because we're trying to bring you in at a level that everybody pretty much understands, a common place. Do we believe in retirement? No, we do not. We believe in a lifestyle change. We think people are going to transition. And the fatal mistake is if you take your money out of production and continue to consume. We think you should switch that from consumption to use and getting it back, just like the real banks do.
Well, what we'll call traditional retirement planning, it's standard procedure to invest in equities, invest in various stock market bonds, sorts of financial instruments that are subject to government regulation, control, and compliance. So what are some of the challenges that you'll experience with traditional retirement planning in those sectors I just described?
Let me categorize it a little bit. I call it, and I'm sure other people will too, it's called herd mentality, when the masses of people do the same thing over and over again, thinking that it's right, when in fact it's not. So the common challenges are, of course, taxes. In the past, as a tax strategist, lowering and paying as little as possible in taxes is very important. It's a parasite. It's there. It's not for you. It's there for other people to benefit from you. And we're at a point now where our taxes are literally taking over. I just heard California announce they want to start charging taxes on savings, for crying out loud. So the taxes on withdrawals are very important. So if you follow the herd mentality, you're going to pay the maximum amount of taxes no matter what. Market volatility is another one out there that's a big challenge. If they've got funds in the market, what's really unique, you're trying to get a return, maybe a percentage of return or an interest rate return, but you get to take all the risk. The people who are holding your money, they won't take any risk. They'll make a lot more money than you do, and they'll pay you into your account as little as they can get away with. But you're taking the risk. Be aware that in the market, there are all different types of risk classifications. The one that really gets to people is you see high earnings, and that's going to be in a very risky side of the table. What we don't understand is that very risky side of the table, if you bring that to the forefront, there is conservative, moderate, and high risk to the high risk category. They don't explain that very well. Okay, they should, they're supposed to. So people look at these things and they say, I want to be as risk adverse as possible. So I want the lowest possible. So they go over to this conservative side of the high risk and show you investments there. And people think, oh, I'm safe. No, they're not at all. Okay, so there's that requirement of the minimum distributions. What that we're talking about when people look at that is that if I've participated in government ERISA trust, which all of these are, Roth IRAs, 401ks, IRAs, whatever a government program will provide comes from a setup of a government trust owned and controlled by the government. So everything about that trust, when the government changes it, is retroactive. There's no such thing as grandfather. So on Roth IRAs, should the government come in and decide, you know what, we're going to go ahead and we have to tax the gain. We already paid tax going in. They could easily change that to tax going out, and they could easily do one more thing. Oh, you know what? Social Security is falling. It's just going bankrupt. We're going to have to shore that up. So we're going to seize some of our other government trusts and put that money into Social Security to shore it up. Oh, we'll be sure and give you credit, but we're not only going to take the tax money, we are going to take the entire account because it's owned by the government that you participated in. But we will give you credit for it. That doesn't sound good to me. Loss of compounding. For instance, if we want to be participating in an account, our money has to stay there. And if it's not returning enough money, will that account ever compound? Will it ever double? Will the earnings go in and will I be able to get earnings off of that? Or every year, am I going to have to pay taxes all kinds of huge questions. Risk, I've talked about. Would I have tax-free access? All of these are kinds of things that we have to plan if we're going to set up a retirement philosophy. If you switch to a lifestyle change, most of this goes away, folks. Most of this means, okay, I've done this. I'm tired of doing that. I want to switch to something else, but I still want to have my money working for me. I still want to get multiple touches on the dollar, get those exchanges, keep those dollars flowing and touching down so I can have volume of return and I can have velocity still in my life. Most of this goes away. It's just, where do we hold the assets? How can we keep it working? Let me give you examples, folks, of how you could easily make that change. If you're into any of the herd mentality accounts, what if you switched it, putting it into a banking strategy, and then lend that out and buy the debt of your family and your extended family? Huge amounts of income, huge amounts of interest coming in, and your money's at work for you. And you carve out the living off of part of the interest.
So you're describing a situation where families take control and have the financial independence and freedom. They're not governed with, for example, when we talked about required minimum distributions, if you've got your money in the government sponsored programs, 401k, IRAs, and other similar type of ERISA plans, when you reach a certain age, you have to take money out, and you can't take the money out before that age, and you're going to be taxed no matter what, no matter when you take the money out, now, later, or otherwise. It's really just a matter of whether you're going to be penalized on top of the tax. And the government, as you said, could change the laws governing the distributions and the taxation and change your whole financial expectation.
Did that story feel like it was about you? Do you feel like you are generating a lot of revenue but are not moving forward as fast as you would like? Do you feel you should be making more progress toward your financial goals? Do you feel stuck? Let us help you get unstuck. Are you ready to take action and get your own private bank? Please visit us at www.privatebankingstrategies.com.
So the problem with traditional retirement planning, as you were outlining, was that you're going to be taxed on withdrawals, whether it's now or later. You're being taxed, we like to say, on the harvest rather than the seed. And that's compared with your family bank, where the after-tax dollars in your banking system never accrue another taxable event with ins and outs of your money.
Correct. The biggest problem people have when they retire is every time they turn around, they got to pay taxes on every payment, everything they do in retirement. If they've used the herd mentality and put all their stuff in these vehicles, it's still controlled. It's taxed. It's also perplexing. And people, we need everyone to understand that when you see your 401k, when you see your IRA, and when you see your Roth, you see a total amount. If you think that is your money, you are sadly mistaken. That's a critical error. The only money from that account that is yours is how much you can get if you had to liquidate it today. Whether it's fees, whether it's taxes, whatever it is, that's the amount of money that is your money. Please realize that difference you are subsidizing for the IRS. You are paying the fees. You are paying the loads so the IRS can get as much tax money as possible. And Seth, you said this all the time to people that we counsel when it comes to risk management and everything else is, do you think taxes are going down? Well, maybe today with the current government we've got, they're going to help maybe stabilize taxes or anything else. But is your property taxes going down, or your state taxes going down, or the taxes according to all the other things that we do going down, or they're going up? They're going up. So these are the things that people are faced with, and you got to have a lot of money to be able to live a lifestyle that you want if you're going to do it the herd mentality way.
So people can buy into an illusory psychological security and thinking, well, my retirement account says 1 million, but really that's if they liquidated it, paid taxes, and it were just a third, they really only got about 60%. And then it also depended on what age they are. If they're withdrawing too early or too late, you've got the penalties. Talk to us about fees and hidden drag that happen in ERISA programs.
Let's take your example of $1 million. $1 million are going to immediately put you in the highest tax bracket that year if you had to liquidate the whole thing. So they got you. You can't put your money to work. You're going to have to pull it out piecemeal. And even today into banking, everybody has that mentality. We need to move this money. We need to get it over here. We need to set up the bank. We need to purchase your debt. We need to get money put into your money vault, we call it, your money warehouse, which is a contract that we help design. And they still balk. They go, I can't because it would put me in a higher tax bracket. So they would rather pay $3,000 a month on their mortgage that's going away from them rather than to increase one taxable rate to another, thinking that the whole thing is going to be taxed at that rate, which it's not. It's only going to raise taxes on that remaining amount and whatever that's going to be. People think that if I liquidated the full $1 million, it's going to put me in the highest tax bracket and it's going to cost me the whole thing. Maybe. It depends on what tax bracket you're in now. If you're in a 30% tax bracket, yeah, you go to 35%. Okay, hidden fees means what type of ERISA program. It may be owned by Uncle Sam, but you may have chosen vehicles that have surrender penalties, chargeback fees. You may order the liquidation and all of a sudden there's normal ticks up and down if these things are in the stock market. What if they actually sell and take your stuff out on a down day? It ticked down. You could lose 10% right there.
So when you're inside your family bank and you've been banking like that, you've got tax-free access and the compounding guaranteed growth, and you've got no market correlation. So you're not tied to the risk that may get that 10% depreciation in your account on a bad sell day.
So people need to realize that 30% of that total is not theirs anyway. Okay? So what we're talking about is that whether there's a penalty added to it, that penalty could be 10%. That could be another 100,000. How long does it take us to make up that 100,000 and double the entire remaining balance again once it's under our control? We bought debt, we put it out there, and now the outflow turns to inflow, totally non-taxable, and we have a way of showing people how fast this money, when you put it to work, doubles. And 2.5 to 5 years is the average, somewhere right in between there. So if we take 700,000 and we double it to $1.4 million in 5 years, let's go to the outside, are we better off than have left that money in there all the time? If you'll break out of the herd mentality is failing, but you get to fail with company because everybody else is around you. The people who succeed alone, because they're willing to do what's right for them right now and explore these things. So that's why we're bringing this up. Retirement is much stronger than a family with children. The tradition is, I want my kids to go to college. Why? Because that's the sign of success. You make it. If you get to go to college, you're going to succeed. That might have been true in the past. That's no longer the case at all. Trade school, these people far exceed most graduates. You've got to look at your situation, and we have to decide what retirement really is going to mean for that person, and then go down this checklist.
Let's transition our discussion into the logic behind a tax-free retirement. Obviously, people want structured and predictable living income in their retirement age, and that's a given. But let's talk about how you structure that properly and how the private banking system and strategies compare to traditional retirement strategies.
It's an education, is what it really is. I don't know how deep we really want to get into that for outside public, But what we do for our clients is we set up a system that creates no taxable events. And we concentrate on volume of return, which is what is the actual payments coming back in our control, into our hands physically on money at work. That's called volume of return. The other big factor in wealth accumulation is velocity. How many times can I use a dollar over and over again? This is going to be a long answer to this, but it's the truth. It's what needs to happen in order to convert. Back in the day when the family was the power unit in America, which was before banking, but it was still during the time our nation started from nothing, brand new country, and went to the number one wealth position in the world. In that first 100 years, we didn't have any banks. The banking equation was handled by the life insurance industry, and they formed contracts that would allow them to capitalize, put money in, and then borrow money out and pay themselves back, borrow it out and pay themselves back, and put money to work. The education back then was how to go out into the wilderness and survive. We were settling America. We were going out into the wilderness, wild animals, wild criminals, robbers, whatever. We had to be able to defend ourselves and survive and produce. So we had the capability of going out and setting up what I call, for everybody to understand, your own town, and being able to move money. We've given this illustration a lot, Seth. Somebody's on a trip, they go into town, they buy a new gas tank full of gas, and they're gone. But they left $50. It cost them $50. Well, that $50 now is new money in town. That gas station owner can take that over to the grocery store, get $50 worth of food. Now that money's over at the grocery store, but the gas station, he has $50 worth of food, and I have $50 worth of gas. So it doubled right there. But now that guy the grocery store owner takes it to the warehouse because he needs more inventory. And every time they exchange that $50, it creates a new $50 worth of product or services. It can turn into several $1,000s. How many times is that happening to our listeners out there right now? It's not. That's the logic of the tax-free. Inside your system, you're using after-tax dollars, folks. And as long as you can keep doing that, making that money move, you can still use it over and over again, and you can create wealth that is not taxable. There's no taxable events whatsoever.
Whereas within the IRA and the 401k type constructs, your money is effectively in prison. You can't access it except this precise sweet point, and then you're still going to be taxed and possibly penalized if you don't observe all the compliance. So those are some of the key distinctions, I think, that are evident with what you're describing, and you're offering a strategy that provides financial independence and control over your own finances with superior returns to markets, superior overall wealth growth and stewardship, and enjoying many of the protections of state law which keep it asset protected. So there's so many check the box superior attributes. It's confusing as to why more people aren't aware of it and why more people aren't utilizing it in America.
I think biblical sayings out there. Those who are left in ignorance become slaves, go into slavery. Those who gain knowledge are made free. And so we need to have this knowledge. We need to have the understanding of how money really works. Everyone thinks they know. The only thing they know is what they've been told that has come from banks. And banks want to end up with all your money. They don't want you to be independent. They want to control every single aspect of life. That's the nature of our banking today. Here's one more philosophy you need to understand. If you participate in any government ERISA programs, you have agreed to be bound by all of their rules, all their laws, and all of their future changes. If you agree not to participate in ERISA programs, you get to be free, left on your own, and be able to do what you want to do, how you want to do it, and you can take advantage of the tax laws out there without crossing any boundary whatsoever. There's a huge gap, folks. We don't think there is. We think we get an advantage if we don't pay taxes on $1 today and pay it later. That's not true. Okay? What if we want to use our own dollars? We have to pay tax, but what if we are smart and pay a lot less in tax that we might have to owe, rather than just let our employers and everybody else dictate the amount of tax we pay? You can talk to us later about that, but whatever else is. Taxes are something that can be controlled and be minimized to your advantage if you act early and you don't sell your soul to the government. And that might be blunt, but when we sign up for these programs, it's exactly what we're doing.
Yeah, folks, if this content is resonating with you, go to our website, privatebankingstrategies.com, and there on our website, Vance and I have authored a book called How to Grow Rich with the Secrets Banks Don't Want You to Know. And we've talked a lot today about things that the traditional banking system, traditional retirement systems, where they fail, and things that are short-sighted but a core of the herd mentality. So in our book, we highlight some of these issues, and we start to red pill folks on how to take the banking equation back in your life. And if this content resonates with you, check out our book, and you can find that on our website. Put your email in, and you'll be notified by email of our weekly podcast so that you can keep listening. Subscribe to our content, share and like if it's something you're finding value in. And more importantly, if all of those things are resonating with you and you want to learn more about it and how it will actually apply for you, how you can develop it in your own family, you can schedule an exploratory call with Vance in a link that's in the emails we'll send to you. Tell folks what we do in the exploratory call, Vance.
We'll use your numbers and we'll show you in detail, month by month, using simple math, simple logic. This is where it resonates. It resonates in the heart. It's not something we have to, I wonder if the interest rate will be this high or the earnings will be. No, it has nothing to do with that. We'll let you see what's called yield, what yield actually means, and step by step. So we let you take it for a test drive. You can see for yourself whether you're going to be better off using the strategy, actually switching to it, versus staying the way you are today.
And that's a step-by-step roadmap that if folks follow it to the T, it will produce the outcome that it shows. Thank you, folks, for joining us today, and we look forward to seeing you on the next podcast.
Thanks very much, guys. Appreciate it.
Did that story feel like it was about you? Do you feel you should be making more progress toward your financial goals? Do you feel stuck? Let us help you get unstuck. Are you ready to take action and get your own private bank? Please visit us at www.privatebankingstrategies.com.
Thank you for listening to the Private Banking Strategies podcast. Click the subscribe button below to be notified when new episodes become available.